All right, so here's a premise, folks. The labor market and other parts of the economy right now apparently weathering the storm, right? The Fed is trying to put on them. And if that's the case, it means that maybe a lot of public traded companies are doing pretty well. And maybe they'll actually deliver earnings that come in above Wall Street consensus. With me now, Kingsview Wealth Management CIO Scott Martin and Bulltick Capital Markets Chief Strategist Kathryn Rooney Vera. Scott, I'll start with you. Now, coming into the week, the pace of negative earnings warnings was actually less than the prior 3 quarters. And everyone is looking, of course, now, one of the general things that I hear from all the guests is that earnings are too high. They're going to be a disaster. Could that, I mean, from a contrarian point of view, actually be setting us up for a positive surprises?
Definitely, and I think I've heard that for a few quarters running now, Charles, and it hasn't happened. So either it's not going to happen, and that could be good, or it does happen, and stocks get overextended to the downside, and that's when folks like you, me, and KRV come in, Kathryn Rooney Vera, that is, if you're playing at home, come in and buy it. And I'll tell you what, that's the one thing I have an issue with a lot of this stuff. You've had some great interviews today. Diane was very good. Ed Yardeni, awesome. But, Charles, a lot of the things we all talk about these days are kind of getting factored in, aren't they? I mean, they're kind of getting known. And the things that really screw up markets these days, to use a euphemism, is when stuff comes in from out of left field, the black swan events. A lot of the things that we're worried about and that we're talking about today are already kind of known to the market, so I don't think we have too much farther down to go, provided some of those unknown things don't show up. You
know, Kathryn, or KRV, third quarter GDP from the Atlanta Fed was 0.3 a week ago. Now it's almost 3%. And it just makes you like, golly, you know, I mean, I know that the Fed is trying to destroy the economy, but, you know, it seems like corporations almost always find a way, a lot of them, the majority of them.
They absolutely do, and Scott's right. The data have been coming in extraordinarily well. But the flip side to that, of course, is that we have above 8% inflation, and the Fed's target is 2%. The risk therein, if the Fed weren't to, as you mentioned, destroy demand, kind of kill the economy, which is really the way to get inflation from 8.5 to 2, the risk to that is that the market doesn't buy the Fed's capacity to drop inflation. So if we continue, let's highlight one thing, 3.5% is a record low unemployment rate. So we went from 3.7, today numbers released 3.5%. We're not going to get inflation to 2% with record low unemployment rate. So the Fed has way extended the expiration date of its ultra lax accommodative policy. It knows it's gotten itself into a corner. It's going to have to increase rates aggressively. I heard your previous guest, and I agree. I think we get to at least 5%. The Taylor rule puts the Fed funds rate at 7.75. I don't think we get that far, right. But unemployment has to go higher to take the pressure off of wages and to take the pressure off of inflation.
So with that, but with having said that, then for a stock investor, is there anywhere to hide out? You know, for a while the defensive names are doing well. More recently, utilities have gotten smashed. Staples are getting hit. Is there anywhere on the equity side, then KRV, that you would be buying right here?
If the Fed does miraculously land a soft landing, which is getting inflation down to 2% without producing a recession, which, you know, it looks kind of possible right now. I tend to think it's wishful thinking, and wishful thinking and hope are not an investment strategy. I prefer to tell my clients, let's just hedge ourselves in case the worst case scenario happens. We get a recession, equities could drop another 10%, something like that. So if we think that's a possibility, which the probability is increasing, so you want to be in the defensive sectors. They're not the fun ones. It's not tech. It's not consumer discretionary, but it is energy, healthcare, utilities, and staples. I've been saying this for some time. They've been winners, and I think there's some more upside there, Scott, going into 2023.
I'm sorry. Scott, you've got some specific ideas. I took some notes. I know that you like AMD today on weakness. About 47 firms downgraded it today. I had a position that we sold at the open. You like Tesla. So you're like these high flyers, and these kind of major days, and they get hammered like this, you want to go in there and start sifting through the ashes right away.
Yeah, damn it, you read my notes, huh, man? I love days like this, certainly on some stocks that, are just getting tossed. I mean, AMD is getting absolutely crushed. And, I mean, the miss was bad, but is it worth 12% in the stock? Yeah, I think that's one of those arguments where a lot of it's already in the stock, so we're going to buy it today on the close here. Tesla's been dropping like a rock, sinking like a stone all week. That company is still firing on all cylinders, pun intended. I think it's great. And then KRV, I should have asked you ahead of time if that was okay to say, but KRV, let's just go with it. I think you made a really good point. Utilities are still hanging in there. Awesome. Good. It was good intuition. And also, Charles, Schlumberger. That's a name I gave you about a month ago. Been really hitting it hard lately. I think that's a good area to kind of hedge out some of that risk that KRV talked about on the energy side, too, just in case energy doesn't settle down here.
I got to think, I mean, every portfolio has to have exposure to the energy side. I mean, it's just for a number of reasons. There's no doubt about that. It's a dangerous game, but that's how you make the big money when everyone else is selling and making and creating those opportunities. KRV, Kathryn, Scott, thank you both very much. Appreciate it.